Warren Buffett and Carol Loomis are here. He's one of the world's most successful investors and a longtime friend of this program. She is the legendary Fortune magazine writer who has followed his career since he was a 35-year-old hedge fund manager from Omaha. Back in 1966, she couldn't even get his name right. When Carol Loomis made the first mention of Warren Buffett in Fortune, she spelled his name with only one T. It was an unlikely start to a beautiful friendship and to Fortune's coverage of the man who we have come to know as the chairman of Berkshire Hathaway. Tap Dancing to Work is Carol Loomis's new book. It is a collection of articles telling the remarkable story of Warren Buffett. It is also a story about friendship. I am pleased to have them together at this table. Welcome.
Thank you.
It's so good to have you both been here separately, but to have you together is
terrific.
I want to talk about the book and about the career and about Fortune magazine and the relationship. But first, this morning we all got up to read an op-ed by you called A Minimum Tax for the Wealthy. And you start off by saying that most investors if it's a good deal, they're not going to be upset about the fact that they're going to have to pay some tax.
Every investor I know. I'm 82 years old and I'm looking like Diogenes. I'm out there looking for that investor who says, I think I'll pass on this chance to make a lot of money fast.
If it's a certain deal, I'm going to pass because
Charlie,
of tax.
I'm going to call you tonight at midnight. I'm going to be panting and I'm going to say, this is the best idea I've ever had. And are you going to say, how much will the tax I have to pay?
I don't think so. Here's how you end the article. You say, in the meantime, maybe you'll run into someone with a terrific investment idea who won't go forward with it because of the tax he would owe when it succeeds. Send him my way. Let me unburden him.
That offer goes to all viewers.
You start that, but you have a serious purpose here.
Sure.
What is the minimum tax that you think ought to be done today by Congress and not wait for all the time it might take and all the deals it might take to reform the tax code?
I think on incomes of over $1 million, that the excess over $1 million should be have a minimum tax of 30%. As you know, they're talking about bringing the top tax rate up to 39.6, and right now the tax rate's 36.
So if you make from $1 million to $10 million, a minimum tax of 30%.
On the million to 10 million, right. And then over 10 million, 35%. And the reason I'm suggesting that is because the 400 highest taxpayers in the most recent year, we have figures for 2009, who had average incomes of $202 million, half of those people paid at a rate below 20%, a quarter paid at a rate below 15%, and believe it or not, average income of $202 million paid nothing. I mean, they were members of Romney's 47%. I mean, and I suspect he got their vote, but they're just a bunch of moochers, just a bunch of moochers.
You think that they voted for him, did they?
Yeah, but well, we've conducted a survey 3 times in my office in 3 different years, and the office has between 16 and probably 21 employees during that period. And each time, my tax rate was considerably lower. I'm talking about payroll taxes plus income taxes, considerably lower than anybody else in the office. And these people made various incomes. And the tax law, in many cases, is not progressive. I think the tax law should be progressive. I think that when people make 15 or 20 million or 200 million and pay a 10% rate, I think something should be done about it.
Say that, people step forward and say, well, that's because most of the income comes from dividends, which is taxed at a lower rate.
Well, they would probably say most of it comes from capital gains, and that's taxed at a lower rate.
I mean, capital gains.
This just makes sure that people that have really high incomes pay at a rate that's sort of like the people next door to them are, who are making $100,000 a year or something of the sort.
If you had automatic powers to establish what the tax rate should be, both for capital gains and for ordinary income, what would you set it at?
Well, I would probably feel that capital gains should be at least at the 25% level, and dividends should be as ordinary income, and I would have a more progressive tax system that we have. But since the lobbyists and the lawyers for the rich are so good at getting around these things, I would have a minimum tax so that no matter who your lobbyist or lawyer was, if you had 10 million or 20 million of income, you paid at a rate comparable to what most of the people who are watching this program pay.
You write about and enormously successful businessmen and women. Do you think that if you sat down in a one-on-one conversation, they would agree with him or not?
Well, I don't think it would be unanimous by any means.
No.
Well, majority.
Does he represent a voice in the wilderness for very wealthy people in the ideas he has about what's necessary and fair to do?
I think there are a lot of people who agree with them, but I'm not sure that it would be over 50% by any means.
Do you think he's right?
I do think he's right. And I must say, my husband worked on Wall Street during a time when there was a lot of income associated with working on Wall Street. And so I'm not talking as someone who wouldn't be subject to quite a lot of tax. And I think the problem is no one's ever talking about the payroll tax. That just doesn't ever come into the discussion. But when you add it in, as Warren has pointed out that you should do, it makes a huge difference. And so I do think he's right.
You hope that the president will be responsive to this. You think it's what ought to happen today.
I hope the president and the Congress is responsive to it. I think that I don't think we should wait around to have a. There are all kinds of things wrong with the tax code, and reform is called for. Expenditure cuts are called for. But I don't want to wait around until all of that stuff is done to do some things that are obvious now. So the people who talk reform, some of them, many of them, really are seeking reform. But some of them are saying reform because it just means pushing things down the road another year or two. And I do not want to have something that obviously should be done be held hostage to getting everything done.
So therefore do the minimum tax now.
I'd like to see starting January 1st.
What happens if the fiscal cliff comes and happens? What will it do to our economy?
I don't think it'll do that much because I think people will assume that a solution will be found quite promptly. It's a little like the debt ceiling question. I mean, people, the rest of the world may think that we're idiotic at times, but they don't think we're going to commit suicide. So I think I hope something gets worked out before January 1st, but if it goes a little bit beyond that, I do not think that. So
January 10th or February 2nd?
I will not be selling. If you guaranteed me that the fiscal cliff, we would go past that, I wouldn't sell a share of stock today.
That you have that confidence that in the end they will fix it.
Yeah, and that this economy works.
Is it getting better?
It's getting better. It's been getting better since really the summer of 2009. And, you know, we've had 4 years straight now where the stock market's given a positive return. I mean, the economy's getting better. We had a tremendous bubble, and when it burst, it had ramifications for all aspects of society, and it was magnified by the abuses that had taken place in Wall Street and all kinds of places. So the dominoes were lined up. We had plenty of problems, but we've been on the mend now for 3 years, and it's taken a long time because it was a big problem. But we are getting better all the time.
This book is about tap dancing to work. Why did you choose that title?
Let me tell you, I've learned a lot about the publishing world and in the last few months, and I learned that the title is a process of negotiation between the publisher and you. And I came up with this after we'd considered 2 or 3 others, and the publisher just displaying great judgment, said, I think that's a wonderful title, let's go with it. And that's what happened, because he is a man who tap dances to work, has forever.
And has talked about it. I mean, in interviews with you have talked about tap dancing. It is someone, you explain to me what tap dancing is.
Well, it just means that I can hardly wait to get to work in the morning. and I mean, it's the most exciting part of the day, is getting there. And there's never been a day I haven't looked forward to.
Do you like Monday through Friday better than Saturday and Sunday?
It depends whether Nebraska's playing football on Saturday. But, yeah, normally...
Or whether they're playing Notre Dame.
Yeah, well, yeah. Well, I don't want us to play Notre Dame this year. But
what makes you think he doesn't go to the office on Saturday and Sunday?
I go to the office on Saturday.
But what you do at the office or what you do at home is the same thing. You're reading and on the phone. That's what you do.
I'm reading and thinking and on the phone and talking to friends. And no, there's very little difference in Saturday and Sunday from the weekdays. A little more action during the week, though.
This reminds me of what surprised you most about him in terms of advice. You asked him what was the worst advice?
I asked him
what the best advice.
Well, we were doing a big act, and he was going to be on the cover, and so I, without truly knowing the answer to the question, I said, "All right, now tell me what is the best advice you've ever gotten in your life from anyone?" And he proceeded to talk for a long time about the worst advice that he had ever gotten. And so I went back and told my managing editor this with probably kind of with my head down and thinking, well, I hadn't come back with quite the right thing. And we put him on the cover anyway. So.
But what's interesting is the way you answered the question, which is smart people told you don't go in the securities business.
Right.
And what did you read from that? Because you went into the security business. And
not only smart people, but people that love me and that I love them. So, I mean, they were giving me their best advice.
Because they thought you weren't ready for it, or the security business was a bad business at that time?
They thought stocks were selling too high because the Dow Jones was above 200. And I always feel on almost anything that if you're going to do it, get started. And I mean, the idea of sitting around and waiting for a different time did not register with me. Now, it's also possible that I was 20 years old then, and you know, I was behaving like I was about 14 and looked like I was about 16 or something. So that may have been their nice way of telling me grovel a little bit before you do it. But beyond that, though, they really did feel this. I mean, here were the two guys I admired the most in the world, and they told me they thought the stock market was too high.
Was this your father and Ben Graham?
My father and Ben Graham, and I just said, listen, I want to get going. You know, I didn't want to go to college.
Well, but the point is, you'd already been going because you'd already been investing since you were 11 years old.
That's true, but now I can do it full time.
So the first time you met this guy,
right,
you were actually doing a piece. Before you met him, you were doing a piece on the hedge fund guy. What's his name?
Alfred Winslow Jones.
Alfred Winslow Jones.
Right.
Sort of the
very famous.
Very famous guy. And the name
Buffett
came up.
Sam Stamen, a bridge player, was an investor in this strange thing called Buffett Partnership Limited.
Yeah.
And I just blithely went ahead and spelled it with only one T. So the first time that he was ever in Fortune, we misspelled his name, and you know, I say that's the editorial we, because it was I who did it.
And since she's never been wrong, I've been spelling it with one T ever since.
Your husband, John Loomis,
yes,
met him first.
Yes, he did.
And came back and said what?
He said, I think I've just met the smartest investor in the country. And, of course, I'm sure, like wives do, I rolled my eyes and thought, oh, yeah. And then I met him with his wife, first wife, Susie, and I realized how terribly impressive he was. And from that day forward, I thought that, too.
This was before Berkshire Hathaway.
Well, he had taken over Berkshire Hathaway, but it was, nobody even knew the name. It was totally insignificant. So then we worked up from that one sentence with the word misspelled to 2 paragraphs in 1970. But by 1977, we had a 7,000-word piece by Warren himself. We recognized that he was a very good writer, and we went forward with that, too. And so this book has a dozen pieces by him, and the one I've just mentioned is only one.
What was that piece, the first piece?
Well, that was how inflation swindles the equity investor.
But people still talk about that piece.
I'm not sure what they say about that.
No, I read that there's still people.
They write him about it. They write us about it. It's a famous piece. It really is.
Well, if you were writing today the same kind of piece, and perhaps you are, other than the letter to stockholders, what would you be saying about where we are?
I would say that I would do a lot of historical things and all that, but basically I would say that for most, overwhelmingly, for people that can invest over time, that equities are the best place to put their money.
I should also talk about the letter to the stockholders. You came in to you knew her, you admired her, you thought she's the best business writer you'd ever met.
Absolutely.
And still do.
Yep.
Tell me about the letter to stockholders and what you want to do with that, and who you're addressing in your own mind's eye.
I'm addressing partners. They're 600,000 of them, but in my mind I usually have my 2 sisters, Bertie and Doris, and they're very bright. They don't work in the financial world. They've been gone for a year, metaphorically, and they've got a lot of their money in Berkshire, and I want to tell them what I think is important to them, what I would want them to tell me if our positions were reversed. So I try to do that, and then I occasionally branch into an essay on something that I think may be important to the investment world generally.
Or even the country.
Yeah.
Okay. And you got involved in the beginning.
Well, I got involved with the letter in 1977.
Right.
And
Warren said, take a look at this.
Well, Warren sent it to me and said, I'm trying something new with the annual report. Would you just look it over and tell me what you think? And I was very timid in what I came back with. I said, I think I suggested changing a "the" to an "a."
Yeah.
And then that seemed to work all right. And so the next year he sent it again, and then it became a routine where he would write it in longhand, his assistant would type it, and it would come to me, and then we would have drafts flying back and forth with suggestions from me.
Well, I think there's a story in here, too, that when the first thing you wrote, the editors wanted to change some things. Was it the first thing? And basically, they almost killed the article because you didn't want that much editing.
Well, and I think that was the 1977 article.
Yeah, right, exactly.
Yeah, Meg Greenfield, who was a famous writer and for Newsweek and the editorial. I showed her the article I'd written, and Meg very gently said to me, "Warren, you don't have to tell everything you know in one article." Oh, like you get wounded, man.
There's a story in there that one of the editors at Fortune went into the big editor and said,
the one who was assigned to the piece and went out to Omaha to get him to change certain things, called up and said, "I'm not having too much luck getting him to change anything. Maybe we should think about not running this." And the managing editor said, "No, I think it's worthwhile." And so we did 7,000 words without many pictures. Really not any pictures.
And so what does she do now? Just dotting I's and crossing?
Well, for one thing, I rewrite it about 10 times before I send it to her. Yeah, and then I send it to her, and she never tries to change the content or anything like that. But she points out when the flow is wrong, where there are lots of grammatical errors, all kinds of things, and sometimes she'll write, "This is my least favorite part of the report," which is and usually it is.
So how many years has it been, this friendship?
Well, what is that? 35 years. Oh, the friendship's been longer than that. The friendship goes back to 1967. Yeah. So that's 40.
She has a charm bracelet. She has, 4 charm bracelets?
Oh, yes.
With every replica of every cover of every report.
So what's the secret to the friendship?
Well, it's certainly on my part, all kinds of things. I mean, she's a wonderful friend, but she also is one of the smartest people I've ever seen, and she's objective and in a very, very nice way. She tells me when I'm full of baloney and a few things.
Is that how you see it, Carol?
Well, I do think that I'm one of the few people who argue with him. I do think that, and I do sometimes about the annual report.
You don't have people argue with you?
Charlie, my partner, Charlie Munger, we've never had an argument. We have a lot of disagreements. And whenever we have a disagreement, his clincher always is, "Warren, when we get through talking about this, you'll agree with me because you're smart and I'm right."
And I would include Charlie in the few people who argue with him. I do think it's only a handful
that will argue with him.
No.
Here is what interests me. Why does he have the record he does? And you have said in a conversation with me, he understands how to look at accounting statements and find the telling point, and maybe in a footnote.
That's true.
So that he'll see opportunity and see the future.
He will. He has an ability to do that I think is matched by very few other investors. And he has this broad, extensive knowledge of business, and I think maybe I said this to you. So when something new comes up, he has a frame of reference in which to place it. And then he adds this rationality that I really think just a handful of investors. Well, he doesn't let emotion take over when he's considering whether to buy. He goes at the decision in a very rational way. Then the price goes down and he buys more, whereas most people panic and sell when the price goes down. And he just he's extremely disciplined in the way he thinks about investments.
This will take a long time to explain, but how is it that you know value so well? So that if it goes down, you know the value hasn't changed, so you buy more. And so that you know the value, so you're not going to pay a nickel more than the value you see.
I only get into situations where I do know the value. There's thousands of companies whose value I don't know. Yeah. But I know the ones that I know, And incidentally, it isn't. You don't pinpoint things. I mean, if somebody walks in this door now and they weigh between 300 and 350 pounds, I don't need to say they weigh 327 to say that they're fat. Right. So if they're in that zone, you know, I'm fine with it. And but I also know that there's all kinds of companies that I can't figure out. So I don't. So I do know. I usually know when I'm dealing with companies that I understand, and then I do. Accounting is a language, and it's a language that I like. And
a language you not only understand but like.
I like it, yeah. I mean,
it speaks to you like music.
It really speaks to me, and when it speaks in a false voice, I can detect that sometimes too. So, you know, I mean, it's, you know, it is almost like playing music. You know, when you look at an accounting statement, and it's not true of all companies. It's not true of all companies at all. But you don't have to be right about. I don't have to be right about the ones I ignore. I mean,
so when you see a footnote that says something to you, you just feel a kind of emotional...
It's in the footnotes. You're right. I mean, the footnotes are the tip-off.
Good or bad, there's the story.
There's a tip-off there, yeah. And Carol is very, very good at this, incidentally, herself.
Yeah. Well, it's so far down the ladder on this compared to where he is.
Let's look at some of the investments at Berkshire. And some of this comes in. You still have a lot of Coca-Cola?
A lot. Yeah.
You saw the value of that early on.
Well, not early enough. I mean, I probably had my first soft drink in 1935, and I didn't buy the stock till 1988. So, yeah, no, I would put me in the slow class on that one.
You still have a lot of Wells Fargo and buying more?
Got a lot of Wells Fargo.
Yeah. Value there, you saw the...
Sure.
And the qualities you look for, management is one.
Sure. And some kind of an enduring competitive advantage. Yeah. Enduring being the emphasis. I mean, and I mean, hula hoops were great for a while, or pet rocks and all that sort of thing. Yeah. But I like something where I think I can look out 5 or 10 years and still see the same sort of advantage that maintaining.
So you just invested in John Deere?
That wasn't me. No, we have two other.
Okay. But you know what they're doing, do you not?
No, I don't know what they're doing. I don't want to know what they're doing.
Why is that? Because you've hired to be sort of your...
They manage... They're managing each, I think, around $4 billion or something like that. And
you don't want to know what they're doing?
No, I don't. They have the responsibility for managing that money. They've got to have full authority. They can't look at me and see whether I'm smiling or frowning over it. And they get paid based on how those securities do.
You have said you're hunting for a big elephant.
You bet. Yeah, the bigger the better.
What qualifies as a big elephant?
Well, in terms of our present resources, probably something from 20 billion, maybe up a little bit.
High.
Well, it would depend on how attractive that elephant was. Not all elephants look alike.
Coming to you, Carol, in just a moment. So you're looking around. How will you go about this process of looking for a big elephant? Because you've said that, you know, the trigger is, you got your hand on the trigger.
Absolutely.
You're ready to fire.
You bet.
You got the money. You got $45 billion or whatever it is, right?
Enough. Yeah.
Enough. You got it sitting right there.
Yeah.
You're prepared to do it. How are you going to find the candidate?
Well, if you're talking about buying an entire business, which we're talking about in this case, I'm familiar with all the companies when you get to that size. I mean, I've been to the elephant ground, and I've seen them all. And
you know,
so it's really a question of when somebody at the company, the CEO, the board, is actually thinking about doing something, and then I can tell very quickly.
Oh, you know whether they are open to.
Oh yeah, whether the initiative really has to come from them, because. You know, Coca-Cola isn't for sale. Wells Fargo isn't for sale. 99% of the companies are
IBM's not for sale.
Sure, and so, and I know the universe of companies of this size we're talking about. And if I pick up the phone one day and somebody says, you know, we've really been thinking about things and we feel that we do better as a part of Berkshire, I'm ready to, you know, hop on the plane.
This is what's amazing, don't you think, Carol, is that a lot of the companies that come to Berkshire Hathaway, they wanted to be there.
That's right.
You know,
that's absolutely
they make a phone call. I'm thinking about the Israeli company.
Yeah.
And somebody says, Mr. Buffett, could I come to Omaha to talk to you?
Right.
And you're pretty quick on the draw to figure out whether you want to go forward.
5 or 10 seconds, sure.
Talk about that.
Well, because
mergers
he does make up his mind in literally minutes, if not seconds, as to whether this is something he wants to consider further. And he will, within that much time, say to the guy on the other end of the phone, well, I'm interested, or, well, I don't think this is for us. Yeah. And he knows, he's seen this great universe of companies, and this is what I was talking about. He brings his frame of reference to it and knows that this company has nothing of a kind of eternal nature to offer, like Coca-Cola has something eternal to offer.
You also get in this book about biggest mistakes, right?
I do.
What's the biggest mistake this guy's made?
Well, Warren himself would say that there are acts of omission where he has known that he should buy a stock and hasn't bought it. One that he cited there is Fannie Mae. This is before Fannie Mae got into trouble.
Name, right?
That's right. But he would have gotten out, I think, but he did get out of Freddie Mac, which was a case where he bought a lot and did get out at the right time. And so the biggest mistakes, well, a couple of times he's been hurt by people who erred in the way that they acted. There's just no question about that. Well, the person I'm thinking about had done a remarkable amount. David Sokol had done a remarkable amount for Berkshire Hathaway. And so I don't think it was something that Warren could have known, that presented with a certain set of facts, that David Sokol acted in a way that didn't work. I bet you asked yourself
that question, didn't you?
Yeah.
You did? Yeah. How could I have not seen?
I don't know the answer.
You don't know. No. You review it in your mind, you don't know.
And he did a lot of good things for Berkshire.
Yeah, of course.
Yeah.
But you've said the hardest thing to do, and it doesn't happen that often, is to fire somebody.
Yeah, it's absolutely miserable. And you know, I don't have to do it very often, but I'd pay a lot of money to have a designated fire. But the trouble is I can't do it because these people are friends of mine.
One of these cover stories, and you have to remind me which one it was, Signal, I think it was the one you wrote, the big profile of the transition from investor to CEO and manager, showing that Warren Buffett had those skills as well.
Right. Well, there are several articles in the book that really pertain to that, but I think the one that you have in mind is the inside story of Warren Buffett.
That was the first big profile.
A big profile, and it was the first big article I ever wrote about Warren. I'd only written 2 paragraphs, that kind of thing. And it was 1988, and he was making the transition then. At the time, he had 6 companies that he called the Sainted 6 or 7?
I think Sainted 7.
7, that's right, Sainted 7. And names like Fetchheimer that they don't ring wildly even now. And but he was clearly headed in that direction. And Charlie was helping him because Charlie was pointing out to him the virtues of things like See's Candy. And they were really, at that moment, transitioning to a company that had been distinguished by its investments to a company distinguished by the companies that it owned entirely. And even today, I think that Berkshire Hathaway is underestimated. Yeah. Warren is not underestimated. But Berkshire Hathaway and its power and might, I do think, is a little bit underestimated.
But you have a reputation for delegation.
Yeah, abdication, actually, call it. I like other people to do the work, Charlie.
I mean, you're not out on the boat somewhere. You're not out, you don't delegate because you want to go do something else. What you want to do is the same thing you've been doing every day for a long time.
Yeah, I like knowing what's going on, but I don't want to direct the orchestra. I want to listen to it.
I once asked him about what was allocation of capital. How would he define it? He said, well, they send the money to Omaha, and I invest it.
That's right.
That's what allocation of capital is.
Yeah, if they're wise, they do that.
And the CEOs of the subsidiaries say they don't even have to worry about it. They just ship it off to Omaha, and that's it.
We'll make it, you spend it. Is that your idea of what makes Berkshire Hathaway great?
Well, it gives us $12 or $13 billion a year to work with.
All right, these are some pearls of wisdom. Rules of investing. Rule number 1, never lose money. Rule number 2, never forget rule number 1. And career advice, I think this is very important. I always tell college students to take the job that you would take if you were independently wealthy. You're going to do well at it. True. Right. You and I.
That's right.
True.
That's absolutely true. And you know that in most companies, merit is recognized. And so what you need to do is to get into a company and show how good you are. And you will get pushed up.
That's exactly what I said.
Charlie, I moved to New York when I was 23. We had a child. We had another one on the way. And I took a job with Ben Graham, who was my hero. And I did not know my paycheck until I got my pay until I got my first paycheck. I never asked what the salary was. I just knew I would love the job.
Mm-hmm. He and your dad still remain the people who had the most influence on you. They
were huge, but I've had others too. I mean, yeah, Joe Rosenfield, Tom Murphy, and certainly my wives, and Carol's had a lot of influence on me.
She plays bridge with you.
Well, she had a lot. Leave aside bridge. She says she had a lot of influence on me.
No. Well, what would you call her up every day?
Just about every day.
Or she calls you every day?
No, I call her.
You call her
just about every day.
So what's the conversation about? Did you see this? It's the kind of thing you'd like.
Just depends what's going on.
Read this story, that kind of thing.
Yeah, it just depends. There's plenty to talk about.
Right, yeah. Big business events, we hadn't been so busy with
your
the
show
book
last night. I mean,
right.
Which you've seen the next morning when you're working out. This is another thing. The internet won't change chewing gum. When I look at the internet, I try to figure out how an industry or a company can be hurt or changed by it, and then I avoid it.
Right.
Take Wrigley's. I don't think the internet is going to change the way people chew gum.
Right.
Well, the innovations are enormously important for society, but they disrupt a lot of things. And, I used in one of the articles in the book, the auto industry. There are a couple thousand auto companies, and a few succeeded barely. And so auto was enormously important. I love the fact it was invented. The airplane was enormously important. But if you take all of what's happened in the airline industry since Orville was down there at Kitty Hawk, some capitalist should have shot him down because he's cost us money. I mean,
what's wrong with the airline industry? Why they're...
Well, it happens to be selling something that's regarded as very much a commodity product.
Right.
The incremental seat cost for the airline is nothing. So they've got this temptation to try to fill the last seat at any price. And if you get 4 or 5 guys that are trying to fill the last seat at any price, you do not get very good prices. And
price goes down.
It's structurally set up so that it's very, very difficult to have a sustained competitive advantage. And you get this enormous fixed investment in planes. Now you got the plane that costs you a couple $100 million, and you're trying to fill a seat, and you're reading the newspaper today what your competitor's charging, and you got to charge the same price. It's got terrible structural aspects to it, and I bought into it.
Yes. Yeah. You've also bought into the railroad industry.
Yeah.
The freight carrying railroad industry.
Yeah.
Burlington,
BNS.
BNS, Burlington,
Northern
Santa Fe. Right. Why'd you do that?
Well, the railroad industry carries 42% of all the tonnage intercity. It carries carrying a ton of cargo 500 miles on a gallon of diesel. I mean, it's an enormously efficient way of moving things. And now you have 4 huge railroads in the United States. They're not going to build any more of them, and it'll be the backbone of the movement of goods 50 years from now or 100 years from now.
What's his history with derivatives?
Well, he has a checkered history with derivatives, I say. First of all, one of the best stories in the book is from 1987, right after the crash of '87, and it's a letter that he wrote Congressman Dingell, in which he warned, absolutely, in which he warned about what could happen with index trading futures trading of index, which was just then being about to be approved by Congress and was approved by it. And Warren warned about that, and if he had been listened to, I think we would be far better off today. And he has always, so that's an early thing about derivatives.
So you saw, go ahead.
I think I actually wrote the letter in '82. But
oh, you wrote the letter in '82, but we printed it in '87 after the crash.
After the troubles came from it.
So you wrote the letter, but it wasn't printed, and it was printed in '87.
Fortune printed it and ran it.
Yeah.
But then on derivatives, what I say about Warren is that he really cannot
ignore securities that are mispriced. I think that he has.
You notice that?
You know, he doesn't go out and buy raw cotton or anything like that, or not very often. But derivatives, in his eyes, have often been mispriced. So on the one hand, he'll be writing in the annual report warning about derivatives, and over on the other hand, he'll be buying those that are clearly mispriced.
Mr. Buffett, I plead you.
Yeah, well, we have 200. I know every single derivative we own, and they're all the product of my purchase. Now, we bought a company called General Re, which had 23,000, and it cost us $400 million before we got out of those. And we tried to liquidate every one. There's still a few left outstanding.
As fast as you could.
Absolutely. But the 200 and some that I picked, you know, I think we'll make money on. But I'm familiar with every one of those. I think when you have an instant, well, Lehman had probably $1 million. I mean, and you get huge counterparty risk. At General Re, when we went in, we had over 900 counterparties. I didn't even know who 300 or 400 of them were. I couldn't pronounce their names. I mean, that is not my idea of prudent finance.
But doesn't Dodd-Frank speak to derivatives?
It does, to some extent, but I'm like Warren. I haven't read the whole thing either, and I have not written about it, in which case I really would have an opinion, but I could not express a strong... The Volcker rule appeals to me.
Does it appeal to you?
Yeah, it appeals to me.
It's the right thing.
In general, yeah, I think the more banks stick with just pure banking, the better I like it. I mean, they have a franchise from the United States government in that people look at their deposits as guaranteed by the U.S. government. It's not totally correct, but that's what they and when you have the ability to take in money from people who feel that they have the U.S. government behind it, they're going to give you money whether you're credit worthy or not. And therefore, you need some real regulation to make sure that people don't go wild with that franchise. And banks, with those funds and with that trust, can do some pretty extreme things, particularly when they've got the upside belongs to the management. I don't worry about moral hazard with stockholders. Stockholders got killed in all these banks, but the managements, you know, they made lots of money and they didn't go away broke.
How do you assess, I mean, this is part of that, I think, what happened in 2008 and the subprime?
Well, it wasn't just subprime, but it was, we lent, we had a housing bubble like the world has never seen. Well, the housing was 22 trillion at the peak out of maybe total assets in the United States is 60 trillion or something. So it was an enormous asset. 50 million people, families, had borrowed against that, and they borrowed 11 or 12 trillion. So you had an asset that had a huge bubble that was owned on margin, basically, and people thought it could do nothing but go up, just like sometimes in the 20s they thought stocks could do nothing but go up. So when that bubble burst, it not only hit housing, you know, it just started rippling through the economy, and we found out that almost every company in the United States was a big domino, and they were lined up very close to each other, and they started toppling.
Do you believe the executives there knew what they were doing?
Well, they didn't. They did not see the consequences of the dominoes starting to topple. I mean, that people, when the dominoes topple, eventually they get to everybody, and people did not realize how big they were, how close to each other they were. I mean, people looked at Freddie and Fannie, which were the first ones to get in trouble in September, more or less, and then WAMU, and then, you know, and then Lehman, and Merrill was going and all of a sudden people realized that if they had bank lines that they thought they could call on, it wasn't going to happen. So it was as close to the wildest panic I ever saw.
The wildest you ever saw.
Oh, by far.
You got out of the hedge fund business in
1969.
Yeah.
You got out because?
I got out because I didn't. I had a good record up till then. I had all these people counting on me, and I thought things were getting very speculative, and I didn't know how to make money in that period. And I was competitive enough to feel that I didn't want to do lousy compared to other people, and yet I didn't want to do the things they were doing. And so the only thing to do was give the money back, and I gave the money back.
What do you think of hedge funds today?
Well, I think that, you know, I've made a bet, famous bet that Carol has been keeping track of, where I'm betting that a large group of hedge funds, I mean, funds of funds, will underperform the S&P over time. I mean,
how many people have taken that bet?
Well, we've got $1 million bet for charity, actually, out in something called long bets. But calling yourself a hedge fund does not make and it gives you no special way to make money, and the fees associated with it are very, very high. And I do not think the results of hedge funds in aggregate will be better than the S&P, which you can buy for through an index.
A couple of years that you didn't do as well as the S&P.
Oh yeah, there's been a number of years. Yeah.
Well, how does that make you feel?
Makes me feel like I better do better next year. No, I mean, that's my job.
Have you noticed he's competitive?
I wouldn't be in this business if I didn't think I was, over time I'd do okay.
There's also the question, which always is asked of you, is succession. You have said the board of directors knows who my successor is as of this moment.
Tomorrow, they know tomorrow. If I die tonight, tomorrow morning they will appoint somebody they know.
And the person they appoint does not know he is the one to be appointed.
That's correct.
Yeah. And will the role be the same role that you have?
No, it'll be half my role. It will be running the businesses, and there will be Todd and Ted, these fellows that come on. They will run investments. They will run investments. My job will be split.
Was running the businesses as important to you as the investment aspect of it, which you grew up on?
Oh, running the businesses will be more important over time, sure. No. It is right now.
Does it have the same psychic income to you?
Yeah, running the business has more psychic satisfaction.
This friendship with Bill Gates, you and I have talked about this many times with you and with Bill, but for this audience at this moment, from the moment that you two had dinner together at Bill's mother's house, and Bill's father started asking questions about what was a quality they most admired, and I think Bill said focus. And
we both answered focus on that.
Focus, that's right. And then you make a decision that, when it came time after Susie's death, that you wanted to do what she would have done to make a huge philanthropic contribution. You chose Bill because you thought that the Gates Foundation did it right.
I chose 5 foundations, but the Gates was the largest one.
Yeah, big one. But the friendship itself is born out of what?
Well, it's like with Charlie Munger or anyone. I mean, you find the other person very interesting. You find them trustworthy. I mean, you have a good time with them. But it's important to point out that there are 5 foundations, and I've just doubled what I give to each one of my children's foundations. So they have over $2 billion each but they couldn't scale up the same way as Bill. He was already operating on a scale.
And the amount for Bill's foundation was more than $30 billion.
Yeah, it would be, and it's probably still about the same. It's 5% of a declining balance. So if the stock goes up more than 5% a year, the amount actually keeps increasing.
What is it, knowing this man as long as you have, shared as many conversations you have, what are you curious about with respect to him?
Well, I don't see how he has as much energy as he constantly has. I think he draws energy from being out, like talking to you. He's amazing about that. I worry about my getting tired while he's just out there just running around all the time. What am I curious about? Well, I wonder what he thinks in his innermost thoughts sometimes about some of his maybe not perfect investments, but I'm not curious about a lot because I know an awful lot.
She knows every chapter of the book. Believe me, I know. She knows it all.
I know a lot of it.
I know you do.
And doing the book, as a matter of fact, kind of refreshed everything that I knew.
Yeah. There is this item too. Berkshire Hathaway has overcome General Electric. It is now the 6th largest company in terms of market value, market cap.
I haven't looked, but that doesn't surprise me that it's in that area.
Does that mean anything to you?
Well, it means.
I bet it does.
What means?
I bet it does.
What means something is having it outperform the general market over time. I mean, my job is to do better for my investors than they would do if they were doing it themselves. And since we retain all the earnings, we've gotten very large, but we'll get a lot larger.
When you first met him, I think Berkshire Hathaway is $22 a share, something like that.
That's right.
It is now $130.
I don't know what it is today, but $130,000 a share, and that's the same stock, $22 to $130,000. Class A stock. It's remarkable.
Let me just come back to the nation's health and
Sure.
the global economy. Europe?
Europe is still drifting downward to some degree. I mean, we have businesses that operate worldwide, and actually, Asia's coming off, the best rate of growth, but they're coming down somewhat. Europe
They're no longer in double digits.
Europe has been sliding, for some time, and the U.S. actually is, I would say, is strongest relative to where it was 6 months ago or 9 months ago. The housing is coming back big time.
And the emerging nations, I mean, even Brazil, they had the high.
Yeah. But 5 years from now, 10 years from now, the world everywhere will be doing better, in my view.
Because?
Just because capitalism and market systems work. I mean, it's been working, since 1776 here, and it wasn't because we had stimulus programs in 1794 or something of the sort. It's because, our system unleashes people's potential, and we've got 312 million people that want to do better tomorrow than today, and over time that works. Human potential is still untapped to a big degree, and our system does unleash it over time. And we do it in fits and starts, but this country goes forward, and it'll continue to go forward. The luckiest person in history, on a probability basis, in my view, is the baby being born in the United States today.
More so than China, more so than in places where the base is lower, and they'll have a greater opportunity to. What has created the most number of billionaires in the last 3 years?
Well, I don't know about the last 3 years, but the finance created a lot of them. And I would say that relative to their contribution to society, a disproportionate number.
Well, that's a point that made. I mean, that some people argue that the financial sector is too large a percentage of our economy.
When you get a huge capitalistic system, just the crumbs that fall off the table can make people very rich. Particularly if they're very good at getting other people to hand them their money, and if they get favored tax treatment and a bunch of things. I said a long time ago that if you want to get rich, per point of IQ and per erg of energy, just hold your nose and go to Wall Street. Well, there's a certain truth there. That doesn't mean they're terrible people or anything like that. It just means the payoff there is so much greater relative to what you bring to the party than it is in most aspects of society. Take journalism.
You're buying newspapers, community newspapers.
Yeah.
Is that simply because you had an opportunity to buy from that particular company, a number of them, or you believe in something, or simply this, like Rupert Murdoch, is in your blood?
Well, it's in my blood, but I won't pay a price that reflects the fact that it's in my blood.
Have you ever paid? I mean, I believe you could argue that Rupert, for example, would buy something because he had to have it.
That's right.
And pay more.
That's right.
Believing that he could make some kind of efficiencies, and he'd still have it.
Yeah.
Have you ever done that? Paid more than you?
No, I wouldn't do it in Berkshire Hathaway. I might.
That's what you owe to your stockholders?
Yeah, I mean, it's their money. That's why we don't take an editorial. I don't dictate an editorial position to the newspapers. We had. I voted for Obama. We have 12 newspapers that endorsed. 10 of them endorsed Romney, and I'm the CEO. But 2 papers endorsed Obama, who I voted for, and 10 endorsed Romney.
Speaking of Obama, the president, do you think he'll be different in the second term?
Somewhat. He won't.
What makes you think that, and how?
Well, I think the second terms are different than the first terms. I mean, first terms
they can be full of landmines too. As you know.
They can be, but in the first term, to some extent, you and your party have to be thinking about your reelection. I mean, and a second term certainly frees up that aspect of it. And then the question is how effective you can be in getting Congress to work with you.
I mean, you have access to him. He calls you.
I've never called him.
No?
I've never called the president.
Yeah, but say he calls and you go and you talk to him on the phone and you go meet him. And other CEOs, do you think he has a new attitude about business that's come about because of the first 4 years?
I think that in the first term, he felt that business misunderstood him, and I think that business felt that he misunderstood. Yeah, they were misunderstood. I just think, I think they.
Do you think he believes in and understands that business is the place where jobs are created?
No question about that. No, he knows he's dependent on capitalism working,
right.
and that business is part of that. I think that to some extent, when people do feel misunderstood by the other party, it can develop its own dynamic. So
that's what happened here.
And I think that does. But I think I think both sides should just say, forget it, you know, wipe the slate clean. And it's sometimes it's a good idea in human relationships generally. I think it's a particularly good idea when the country's well-being is at stake. So I would recommend both sides just say, maybe I was misunderstood by you, but forget it. We work together going forward.
But do you think he wants to do that?
Oh, I think he wants to succeed big time, and I think he will, and I think the economy will be a help to him. But I think I mean, that doesn't mean, you know, neither side can roll over in terms of the things they feel strongly about. But I feel the rhetoric certainly should be very civil all the time, and I think that you look for ways to work with each other.
Would it send a big signal to the country if he would appoint as Secretary of Treasury someone like Jamie Dimon or Jamie Dimon?
Well, I think that might be a big signal. Mm-hmm.
Appointing Jamie Dimon as Secretary of the Treasury.
Well, I think Jamie Dimon actually would be. I think he'd be terrific, because I think he. If we did run into problems in markets, I think he would actually be the best person you could have in the job.
He knows as much about markets as most people.
And I think the world leaders would have
And so when you see a problem that's like Jamie's had with London and the whale and all that, what do you mark that up to?
If you run a $2 trillion institution, if I run Berkshire for decades, you know, some things are going to go wrong. I mean, if you run an army, if you run a church, if you run a government, any large institution, people will go off the reservation sometimes, and sometimes they'll get away with it for a long period. And of course, when you work in a financial institution, you can add a lot of zeros very quickly. Yeah. So, you know, obviously, you know, there was a failure of control, but there's been failures of control at Berkshire. I mean, I am going to make more mistakes. I mean, I hope I minimize. I hope I catch them fast, but there can be mistakes, and there can be big mistakes.
Should Bowles-Simpson be the operating model from the menu that they operate on, and do you believe that's the direction to go?
Well, I think the menu should be to come up with something that raises 18.5% of GDP in revenues, and it embodies and with no loopholes, basically, the idea of a progressive tax system. And I think that expenditures should be reduced to the 21% of GDP level, and I think that will be very sustainable, those ratios.
It will not eliminate the deficit of the debt.
It doesn't. It does not eliminate the annual deficit.
Right.
It keeps the debt as a percentage of GDP constant, and
that's what we can live with, and
we can live with it. I mean, the net debt is in the 70s. It's around 73% or something like that, and that's what we always talked about until everybody got excited lately. That was 120% coming out of World War II, and it will stay in the 70s. It might even come down into the 60s if the 18.5 and 21 will not increase the ratio of debt to GDP. And it very well may bring it down slightly.
What has this meant to you, this friendship with Warren Buffett?
Oh, well, it's been a wonderful friendship. Can you imagine the chance to talk to Warren Buffett about almost anything, to ask his opinion about every story that you've ever had on your mind? It's priceless. And it's been priceless in a way to go at this book and to see it all put down again, to add my introductions, and to see how good fortune was at staying with this man. As I say, we were standing by while Warren Buffett was becoming Warren Buffett. And it was a remarkable thing that we were allowed to do, and I loved it.
I'm smart enough to give her the last word.
You are smart.
This book is called Tap Dancing to Work, Warren Buffett, on practically everything from 1966 to 2012, collected and expanded by Carol J. Loomis. Thank you.
Thank you, Charlie.
Thank you, Charlie.
Thank you for joining us. See you next time.